more than 30 years, America's most widely watched and trusted source of economic and financial advice. Wall Street Week with Louis Rukeyser is made possible by Deloitte & Touche. It's an automated, wired, digitized push zero for more options world. Who can help business make sense of it all? For professional services, the answer is the people of Deloitte & Touche. By Oppenheimer Funds. Skill, experience, strength. The strategy Oppenheimer Funds uses to achieve long-term performance. Oppenheimer Funds, the right way to invest. By A.G. Edwards. Committed professionals providing a full range of financial services and investment advice. A.G. Edwards. Trusted advice, exceptional service. And by the Federated Kaufman Fund. The experience of Kaufman, the resources of federated investors, managers of over $145 billion in assets. Produced Friday, September 21st. Tonight's special guests are Byron Callan, defense analyst, Merrill Lynch. A. Michael Frinquelli, insurance analyst, Renaissance Fund Advisors. Raymond E. Neidl, airline analyst, ABN AMRO. And Paul Ting, oil analyst, Solomon Smith Barney.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, it wasn't pretty. There was unforgettable heroism among the victims and the rescuers. But the financial markets, even after what was supposed to have been a useful time out, staged a historically panicky retreat. Mumbling legalistic rationalizations like fiduciary responsibility as an excuse for what rapidly descended into unchecked hysteria, many large institutional traders in this country and abroad dumped stocks in the very kind of emotion-driven excess that they so often and so incorrectly describe as the typical behavior of individual investors. We had warned you last week that the economic impact of those terrible events would not be good, that it would clearly hurt certain industries, and might well push the entire country from the edge of no growth into what would now be an unarguable recession. But the actual reaction, destroying nearly $1.4 trillion in the value of assets, was a long way from a sensible short-term adjustment to unexpectedly bad news. By the end of the week, a nerve-shattered Wall Street seemed to have discounted virtually everything short of a total permanent shutdown of American business. Never mind that sensible executives like General Electric's new CEO, Jeffrey Immelt, said publicly not only that this too shall pass, but that, in his words, the company will be better and stronger in the future. Well, nothing could compare to the human tragedies of September 11th. This week, which many had hoped would be an impressive show of American financial resolve, was nothing short of a financial disaster. The 14.3% fall in the Dow Jones Industrial Average was its worst weekly battering since July of 1933, when the U.S. was in depression and the emerging international threat was Adolf Hitler, not Osama bin Laden. Major market indexes, shredded by unremitting selling, stand tonight at their lowest levels since October of 1998. Even the inspirational speech of President Bush, so widely praised in both parties, added to some investors' fears, with one institutional manager noting that Bush had set the bar pretty high in terms of wiping out terrorism, and many others cringing at the thought of an extended and expensive effort to make this a more secure world. Will nerves settle and markets find a bottom in the days immediately ahead? After this week's distraught performance, it would take a very bold optimist indeed to forecast a dramatic comeback soon. But despite the way it may have seemed at times during this week's fat cat frenzy, America is not about to go out of business, nor is our longer-term economic future permanently dimmed. Tonight, in another special telecast, we're going to look at 4 key industries in the path of our shocked nation. Some with companies that are already gasping, others that may perversely be actual beneficiaries of the unspeakable terrorists. But first, let's measure the week's financial downturn. The Dow Jones Industrial Average not only had its worst percentage loss in nearly 7 decades, but it came amid history's heaviest trading on the New York Stock Exchange. More than 10 million shares for the first time ever. It was the Dow's biggest weekly point loss ever, nearly 1,400 points, leaving the blue chip index at 8235, which it hadn't seen for nearly 3 years, and placing it now, like all the other major indexes, unmistakably in a bear market. All of them are also at lows since October 1998, except for the Amex, which bottomed a year later than the others. As I noted last week, because of the continuing impact of these extraordinary and tragic events, which no one could have predicted, we're going to give our elves a rest for a while. There were the occasional winners amidst the carnage. Gold got back a little of its old role as a refuge in times of crisis, rising past $291 an ounce. Still a long, long way from its former glories, but its highest price since the middle of last year. But oil couldn't sustain its surge of last week and finished below $26 a barrel, its lowest level in 2 months. Now, before we meet tonight's special guests, leading experts on 4 areas of the economy heavily affected by last week's events, let's check the stock performance of each of those industries in the year before the attacks and in the week since the markets reopened. For comparison, stocks in general, as measured by the Standard & Poor's 500 stock index, lost 26.6% in the 12 months through September 10th, and have fallen 11.6% this week. The S&P Airline Index had lost less than most stocks in the year before the terrorism occurred, just 6.3%, but was severely hit this week, down by 29.6%. Property and casualty insurers actually had a slight up year before the attacks and were ahead by 3.6%, but have lost all that and more this week with a 12.6% decline. The troubles at Boeing assured a glum result even for the S&P Aerospace and Defense Index, which had fallen by 10.2% in the 12 months before the hijackings, and has surrendered 11.1% since then. And there was no refuge in international oil stocks, which had fallen just 4% in the year before the crisis, but 13.5% this week alone. Nor in the long-suffering oil drilling and equipment group, which had tumbled by 41.7% in the year before September 11th and surrendered 12.3% this week. With me tonight are 4 leading analysts on key affected sectors of the U.S. economy. Raymond E. Neidl is the crack airline analyst for ABN AMRO. He has been in Wall Street for 17 years and previously worked for American Airlines. Michael Frinquelli of the Renaissance Funds Advisors has analyzed insurers for more than 30 years. Since 1997, he has been checking their books for the hedge fund he co-founded in 1997. Byron Callan is Merrill Lynch's aerospace and defense analyst and has been covering the industry since 1987. And Paul Ting is the top-ranked oil analyst who has covered both the international and domestic industries for Solomon Smith Barney since 1995. Ray, what's going to be the impact of Congress's bailout plan for the airlines?
Well, I'm hopeful that if the bill goes through the way I think it's structured, with both a cash infusion and limitations on the insurance liability, that we may have a brief a rally early next week off of the lows that the airlines have hit this week.
How serious is the damage the airlines have received in terms of their financial future? Extremely
serious. Airlines were in a good position to take on the next recession, but something of this magnitude they're just not equipped to. People aren't flying, they've got high fixed costs, and they really do need this relief.
Well, what do you say to those people? How can you offer them any assurance that they can fly safely now?
That's just it. the federal government is probably going to have to federalize the security and convince the traveling public that it's safe to fly. Once that happens, then the airlines can offer incentives to try and get people to start flying again.
We shouldn't forget that the economy was in pretty poor shape before this hit. In what shape were the airlines?
The airlines were probably going to lose large amounts of money, anywhere from $2.5 to $3 billion. They had a big fall off since last spring in business travel, so even before this incident, they were going to lose a lot of money this year. But they were in a position where most of them could handle it.
Last week, as I reported last Friday, Midway Airlines went out of business. Are there going to be others going out of business?
I would guess that the smaller carriers are very much at danger, depending upon how long it takes customers to come back. Every large carrier is at risk, maybe with the exception of Southwest, if we don't get a aid bill. But with the aid bill, I think that gives them a chance to try and stabilize the industry. There are a couple of weak big carriers, though, that are very close to liquidity, Marco West being one of them.
You know the airlines as well as anybody. Are you afraid to fly on them?
No, I flew a couple times since the incident.
What would you tell investors about their prospects?
Probably investors, I would tell the traveling public it's safe to fly than ever. With investors, I'd be taking my time and I'd be trying to pick the survivors. Stock prices are so low that when they come back, the survivors are going to come back strongly, but I think you got time to pick the ones you want.
That means you wouldn't rush in Monday morning, do any buying?
If I was a hedge fund, I think I would be buying Monday morning, but for the short term. If I was thinking more longer term, I'd be doing my analysis right now, looking at balance sheets and trying to decide which ones I want to buy for a 2 to 5 year time parameter.
And what's your conclusion, having done that work?
Well, Southwest by far is the strongest balance sheet. I feel comfortable buying that stock. Of the regionals, Atlantic Coast and SkyWest, I think they're actually going to benefit because the big carriers will actually have to use more regional jets, which they're buying. And of the big network carriers, I think I would go Delta, AMR, and then maybe possibly with a little bit more risk, Northwest and Continental.
You notably didn't mention United.
United was projected to have huge losses even before this incident. They'll probably be even bigger since then. And I just want to, they seem to have more than enough liquidity, but I just want to evaluate that situation a little bit more.
Michael Frinquelli, what's this mean to the insurance industry?
Well, in terms of earnings, it hurts. It takes away, for giving companies anywhere from 3 to 18 months of earnings. In terms of capital, it's manageable. The U.S. industry alone has about $300 billion in surplus, and most estimates of the loss here, insured loss, are about $35 billion.
The leading insurance companies have indicated that they will not try and welsh on their obligations by claiming this was an act of war not covered. Will that be universal?
Yes. Politically, as well as clearly emotionally, it would be totally unacceptable.
You've suggested there's been a lot of misinformation about the industry in the wake of the disasters. Would you elucidate on that for us?
Well, one example is this act of war issue. One company was, as it turns out, misquoted several days ago in a major publication, saying they hadn't made up their minds yet, and that in turn resulted in the company having to put out yet another release saying, we mean it. We're not going to invoke active war clause. In the interim, the stock came down almost 15%, at least in part because of that information. In other situations, companies have given out early estimates, but partial, and have suggested them as partial. When they came out with more complete estimates, that's been reported as an increase in the estimate. It was simply a matter of going from property only to property and liability coverage, as opposed to now that we guessed wrong the first time, and now this is the correct number.
With somewhere around 7,000 lives lost, it's hard to think of anything other than the human cost. But who's going to pay the financial bill?
Well, mainly the private industry. About 2/3 of the bill will be paid by U.S. companies. Another third by mainly European companies, Munich Re, Swiss Re, and Lloyd's, of course. Life insurance will be cut. Life insurance of the $35 billion I mentioned, this is no easy way to say this, but only about $5 billion is life insurance.